what is your base case for what OPEC will actually do with Russia?
They're going to certainly bring oil back into the market. The question is how much and how soon. It looks as though they're trying to do it in a staged way. The Russians have kind of said again today that they want to do this on a proportional basis. The problem with the proportional basis is that most of the countries in OPEC are seeing their production decline for more or less permanent reasons. There are only a few that can bring oil back. They're basically Saudi Arabia, Kuwait, and the UAE, those three countries, and Russia. So they're going to do it. The question is, what is the optics going to be? And it may be a lot of screaming at one another at the meeting in June.
Right, let's talk about what Russia wants. Bloomberg spoke to Mr. Novak, the energy minister over in Russia. Here's what they had to say.
We have always been saying that we can live in any oil price environment, and the prices of, and I'll say a range now, 55, 60, 70, they suit us, because they're volatile, but that's a normal range.
55, 67, 70, that seems like they're going to want to pump about 1 million barrels of oil a day.
He actually said 60 was a good number, and that's right. There's a very big difference between Russia and Saudi Arabia when it comes to the dollar price of oil. The ruble tends to depreciate against the dollar when oil prices are low. There's a very strong correlation between the ruble and the price of oil. The Saudis are dollar priced, so they like the price to be higher because they get more revenue at a higher price. The Russians can actually get more revenue at a lower price if you think of it in ruble terms.
Oh, interesting.
So you said that many of the countries that are curtailing have to. Now, I assume you're talking about Venezuela. I mean, that's they can't bring that right back online again. But what about Iran and Iraq? Because you didn't mention them.
No, I didn't mention Iran and Iraq, but I didn't for good reason. So on the Iranian case, production is down. We expect it to go down more because they're not attracting investment from outside. The sanctions really hurt. And even with the lifting of sanctions, they were not attracting a lot of investment. So the terms that they're offering to the market are not very attractive, and their production is going to decline one way or another. The question is by how much. Iraq is a different story. They've just had elections. Those elections are having a very prolonged period before we see a government in place. Yes, they can do things to move the needle up in terms of production. That has to do with their relations with companies, but they're not going to do anything in the next 90 days. So they can't raise production either.
So there are two stories I feel like emerging from this. One is what we're seeing reflected in the spot price, which is, they're going to pump production. It's going to alleviate all the supply guts. We already have oil coming out of the Permian. Everything's going to be just fine. We're going to be oversupplied at some point. The other story is that you can pump all you want, but that's going to erode spare capacity, and we have a particular tight market now, and it could get worse. You have to wind up pumping. It's not sort of putting a cap on prices. Which camp are you at?
Well, I'm actually in both camps. So yeah, to be sure, be sure, if you raise production and you have spare capacity, that spare capacity number is going to go down. On the other hand, we're having drilling activity taking place in a bunch of those countries. Just take a look at Kuwait and the UAE. They will, by the end of the year, combined have 800,000 barrels a day of more production capacity than they did in January 2017 when they reduced production. They've reduced production combined a little under 300,000 barrels a day. So they alone can add 1 million barrels a day to the market if they want to do it fully. Saudi Arabia has real spare capacity. They can do it in multiple ways. They can bring on stream fields that have been mothballed, like the Safaniya field in the Gulf. They can do infill drilling and surge production if they really want to. And they also have, with Kuwait, the neutral zone with some 625,000 barrels a day of capacity that they've shut down for political reasons, strange political reasons. But nonetheless, there's a lot of oil there. So there is spare capacity, and there will be. And yes, we've got production from the Permian, from Canada, and from Brazil that's rising. And in the outer years of this decade, we'll see production from Norway. We'll see production from Guyana with a very big discovery. So I think there's plenty of oil around.
So talk to us about those outer years, as you said, of the decade. As you look around the world right now, who's investing? We've seen the consequences of not investing, whether it's Venezuela or maybe Iran, places like that. Who's really investing right now so that down the road we really will have substantial more production?
So there's a lot of investment taking place, obviously, in the U.S. And that, just we ought to remind ourselves, is good for about 1 million barrels a day of year of incremental production growth. So that's not bad in and of itself. We're seeing a resurgence of deep water. That resurgence is seen mostly in the Western Hemisphere, in the U.S. Gulf of Mexico, offshore in Brazil, where we expect, as I said earlier, 300,000 barrels a day of production coming on stream in 2019. And it's true with a new discovery offshore Guyana, a discovery that was made in 2015, 2016. with new production coming on in 2020. And by 2023, that's going to add another 400,000 barrels a day. So there is a lot of investment. OPEC and the IEA talk about a supply gap. The supply gap is in OPEC. It's countries like Venezuela and Iran that are seeing production not growing. And if you look at the rest of OPEC, Angola, Algeria, Ecuador, that production is down too. It's down for lack of investment. So the supply gap's in OPEC, not non-OPEC.
So the conversation to many analysts say that you could see upside risk to $100 a barrel oil. Is the conversation better spent talking about $40?
Well, the risk is obviously there. Because we're seeing the failure of the petrostate, and we saw it in Libya. Libya has not come back. It could happen in Libya again. It could happen in Nigeria.
So it's a real risk that we see $100.
But it would not last long. It won't last long, largely because OPEC producers that have the capacity will come back, and the U.S., Brazilian, Canadian, and other production keeps growing. And with $100, we'll see a rapid economic slowdown. So the demand push on the oil price won't be there as well.
So then is the floor 40, or is the floor like 50, 60 now?
Well, we've been saying the soft floor is 40 and the soft ceiling is 75. We've seen the price go up above 75. It didn't last. It didn't last in part because the element that came off, in our judgment, is the political risk element that raised oil prices in Brent to $80 a barrel. Political risk is there. It comes and goes. And now we're seeing the risk on the other side with the meetings in St. Petersburg last week.
Well, you mentioned demand. Where is demand right now? Because we've had some reports, at least, that demand is already being curtailed because of the high price of oil. Is that true?
Well, it is true that the IEA reduced its outlook for demand this year by 100,000 barrels a day.
But Alex doesn't believe the IEA for some reason.
It makes me real
well,
mad.
the spread between the IEA and the top forecast in terms of the most optimistic, if you want to use the word, of demand is about 2 million a day. But the intriguing thing about demand is that there's a big slug of demand, about 30 to 35% last year, that came from petrochemical feedstock demand. Now, petrochemical feedstock doesn't come out of a refinery. It doesn't come largely out of black oil. It comes out of natural gas liquids. So if you really think about where the demand is, and let's say you have a 1.8 million barrel a day horizon for demand in 2018, about 1.2 million barrel a day comes out of the refining system. It's a much lower number than the frightening close to 2 million barrel a day number.
So I can't let you go before asking you about the Permian, the takeaway capacity issues there, and the spread between Midland and Houston WTI. How wide does it get? When does the problem get resolved?
It can go up to $25. I don't know what the number is. You run out of trucking capacity, and there's a problem. The problem is twofold. First, you've got a lot of associated natural gas. That has to be piped out. We expect natural gas discount in Waha in the pricing point in the Permian to potentially go to zero, or have producers give it away because the problem of takeaway for gas is really very, very big. You can flare the gas. Texas Railroad Commission allows it for 180 days, period. It's not 180 days a year, it's 180 days. So it can affect oil production. And on the oil side, the production growth has been palpably greater than the takeaway capacity. And we see that in the spread between crudes in Midland and crudes in Cushing or crudes on the U.S. Gulf Coast.